Amidst global economic changes, the 2024 Recession Law emerges as a crucial piece of legislation promising to shape financial markets. This chapter is written to help you thoroughly understand the impact and implications of this law. With the right insights, you'll be better equipped to make informed and potentially profitable decisions in a recessionary environment. The 2024 Recession Law is a legislative package designed to mitigate the effects of economic recessions and stimulate sustainable growth. It contains measures aimed at market stabilization, support for small businesses, and the promotion of investments in strategic sectors. Among the key points of the law are fiscal incentives for long-term investments, policies for streamlining startups, and financial support mechanisms for critical sectors such as technology and infrastructure. One of the most notable features of the 2024 Recession Law is the encouragement of stock investment. Through tax reductions and subsidies, the law seeks to encourage investors to maintain or increase their positions in the stock market, especially in companies exhibiting strong long-term growth potential. This creates a conducive environment for identifying undervalued stocks and applying Warren Buffett's value investing principles, such as seeking a margin of safety. The law also provides incentives for the real estate sector, with reduced financing rates and facilitating access to mortgage credit. During a recession, these measures can be particularly advantageous for those seeking to acquire undervalued properties with high chances of future appreciation. Knowing how and where to invest in the real estate market can be a significant advantage for your portfolio. Understanding the details and nuances of the 2024 Recession Law is crucial to adequately prepare for the challenges and opportunities ahead. Financial planning and a well-defined investment strategy aligned with Buffett's principles will be your main tools to turn a period of crisis into a path to enrichment. Throughout this video, we'll delve into specific strategies and case studies that demonstrate how to apply this knowledge in practice. Prepare for a journey that will not only broaden your understanding of the legislation, but also equip you with the necessary tools to thrive during an economic recession. Investor psychology in times of crisis. In periods of recession, investor psychology undergoes severe testing. Market behavior is often guided by emotion, leading many to make impulsive decisions that can result in significant losses. The first step to overcoming this emotional trap is to recognize that fear and greed are powerful forces that can distort reality perception. Warren Buffett is known for his ability to remain calm amidst the storm. His approach is grounded in the intrinsic value of assets, value investment principles, and a long-term vision. During a crisis, while many sell in panic, Buffett seeks shares of solid and undervalued companies. This rational and disciplined behavior is not natural for most people, but it can be cultivated. Another important aspect is information management. Successful investors know where and how to obtain reliable information. Instead of being swayed by alarming headlines, they conduct their own analyses and make decisions based on solid data. Emotional discipline is essential. Warren Buffett often advises to stay calm and avoid rash actions. He emphasizes the importance of patience and the ability to see beyond the market's momentary fluctuations. Learning to master emotions and trust well-founded strategies can turn potential crises into growth opportunities. Finally, adopting a long-term mindset is fundamental. History shows that markets recover, and those who remain steadfast in their strategies without being swayed by fear tend to emerge stronger. Cultivating this mindset can be the difference between losing everything and maximizing gains in times of recession. Warren Buffett's investment principles. For those wishing to successfully navigate the stormy seas of an economic recession, understanding and applying Warren Buffett's investment principles can be the key to financial prosperity. In this chapter, we'll explore the fundamental concepts that have guided Buffett throughout his career, allowing him to accumulate impressive wealth even in times of economic crisis. Buffett is widely recognized for his approach to value investing, which involves buying undervalued stocks in solid companies and holding them for the long term. The first central principle of this method is the analysis of companies and their fundamentals. Buffett emphasizes the importance of delving into financial statements, assessing the company's health, its growth potential, and the competence of its management. Instead of focusing on short-term stock price fluctuations, Buffett focuses on the business's intrinsic quality. Another vital principle is the margin of safety. This concept suggests buying stocks at a price substantially below their intrinsic value, providing a margin for possible misvaluations or market uncertainties. This approach reduces risk and increases the possibility of long-term returns. Buffett also values the resilience and durability of the companies in which he invests. He seeks businesses that have a lasting competitive advantage, such as a strong brand, a loyal customer base, or exclusive patents. These characteristics allow the company to maintain its position in the market and achieve sustainable profits, regardless of economic conditions. In addition, discipline and patience are crucial qualities for successful investors. Buffett believes it's essential to have the patience to wait for the right opportunities and the discipline to not blindly follow market trends. In the context of the 2024 recession, this mindset can be particularly useful, helping investors avoid rash decisions driven by fear. By applying these Warren Buffett principles, you'll be better prepared to identify and seize investment opportunities that arise during the 2024 recession, allowing you to build and protect your wealth effectively. Identifying opportunities in undervalued stocks. Identifying undervalued stocks requires a combination of detailed research, financial analysis, and market understanding. First, it's essential to understand what is meant by undervalued. Essentially, an undervalued stock is one that is trading at a price lower than its true intrinsic value. Warren Buffett employs a value investment approach, focusing on companies that are fundamentally sound but whose stocks are temporarily low. To begin, you should analyze the company's fundamentals. This includes reviewing financial statements such as balance sheets, income statements, and cash flows. Look for companies with a proven track record of stable profits, low debt, and strong free cash flow. Companies with these characteristics tend to be more resilient during economic crises. Another important factor is analyzing the sector in which the company operates. Some industries are more recession-resistant than others. For example, sectors like healthcare, utilities, and essential consumer goods tend to maintain demand even in times of crisis. Focusing on companies within these sectors can offer greater security. Additionally, assessing the sustainability of the company's competitive advantage is crucial. Warren Buffett values companies with moats, or economic moats, that protect their market against competition and ensure long-term profitability. Finally, calculate the margin of safety, which is the difference between the estimated intrinsic value of the stock and its current market price. This margin protects the investor against judgment errors or unexpected market fluctuations. Identifying undervalued stocks is not an easy task, but by mastering these strategies, you can turn recessionary periods into lucrative opportunities, aligned with Warren Buffett's value investing principles. Real estate investments in times of recession. Economic instability often discourages investments, but recession can also provide unique opportunities in the real estate market. This chapter will address strategies to identify and capitalize on these opportunities, based on Warren Buffett's principles and the specific economic dynamics of 2024. During recessions, the real estate market tends to experience a decline in prices due to decreased demand and increased supply of properties for sale. This creates a conducive environment for investors seeking to acquire undervalued properties. The key is to make informed and strategic choices, considering location, appreciation potential, and financing conditions. Warren Buffett advises seeking intrinsic value, which invariably requires deep analysis of properties, including their physical condition, area development, and local economic prospects. One effective tactic is to focus on areas that, despite the recession, have post-crisis growth potential. Developing neighborhoods, proximity to commercial centers, and future infrastructure projects are positive indicators. By acquiring properties in these locations, you not only secure a bargain, but also significant future appreciation. Financing during recessions can also be advantageous. With falling interest rates and economic incentive programs, credit conditions tend to be more favorable. Taking advantage of these conditions to secure affordable financing can further increase your long-term return on investment. Additionally, diversification is essential. Do not concentrate all your resources in a single type of property. Mix residential with commercial properties, and also consider short-term rental properties, which can offer steady cash flow even in times of crisis. Observing these principles can transform the adverse nature of a recession into an opportunity for growth and appreciation in the real estate market, following the wisdom and practices of one of the world's greatest investors, Warren Buffett. Portfolio diversification for your financial security. Portfolio diversification is one of the most fundamental strategies to ensure financial security in times of recession. In this chapter, we'll explore the importance of diversification, the different types of assets you may consider, and how to balance your portfolio to minimize risks and maximize returns, especially in challenging economic contexts like that of 2024. Diversifying the portfolio means spreading your investments across different types of assets, sectors, and geographies. This practice helps minimize risks because the volatility of a single asset does not affect the entire portfolio. During recessions, this strategy becomes vital to protect your wealth against significant losses. Firstly, consider allocation in stocks from various sectors. Basic consumer goods, healthcare, and technology companies tend to be more resilient during economic crises. Investing in shares of stable companies with a long history of growth and dividend payments is a tactic that Warren Buffett always recommends. In addition to stocks, fixed income securities are a prudent addition. Government bonds, for example, are generally considered safe and can balance your portfolio during periods of high volatility in the stock market. Real estate investment trusts, REITs, are also a good option. Even during recessions, the real estate market can offer steady income through rentals while providing long-term appreciation potential. Investing in commodities like gold and silver can be a form of protection against inflation and economic uncertainties. These assets tend to maintain or increase their value when markets are in decline. Finally, do not underestimate the importance of international investing. The global economy is interconnected, and diversifying geographically can protect against specific risks of a single country. By combining these different types of assets, you form a diversified portfolio that can better withstand economic downturns, providing a solid foundation for achieving your financial goals even in times of recession. The power of Margin of safety. The margin of safety, popularized by Benjamin Graham and adopted by Warren Buffett, refers to the difference between the intrinsic value of an asset and its market price. In simple terms, it's the cushion that protects investors against valuation errors and short-term market fluctuations. During recessionary periods, this strategy becomes even more vital as market volatility increases and asset valuation accuracy becomes more complicated. To calculate the margin of safety, the first step is to determine the intrinsic value of the asset. This can be done by analyzing the company's fundamentals, such as profit, cash flow, assets, and liabilities. The goal is to find companies whose stocks are trading significantly below their intrinsic value. For example, if an analysis determines that the intrinsic value of a stock is $100, you should consider buying that stock only if it is trading at a significantly lower price, say $70 or $80. This discount provides a margin of safety of 20 to 30%, offering protection against uncertainties and errors in valuation. A robust margin of safety allows investors to act with more confidence during economic crises. They not only limit their potential losses, but also position themselves to achieve significant gains when the market eventually recovers. Warren Buffett always emphasizes the importance of investing with a wide margin of safety, stating that it is essential to protect against the unpredictable. By adopting this strategy, you not only follow a tested and proven principle of one of the world's greatest investors, but also ensure that your investment decisions are based on solid and prudent analysis. This translates into greater financial peace of mind and long-term growth potential, even in times of recession. Business strategies and entrepreneurship during crises. During periods of economic crisis, many see growing difficulties as insurmountable. However, investing in effective business strategies and entrepreneurship can prove highly profitable even in times of adversity. This chapter will explore how to identify and capitalize on these opportunities. Recessionary times, although challenging, are known to generate unique opportunities for visionary entrepreneurs. Historically, several successful companies were founded during economic crises, seizing market gaps and new demands. Companies like Microsoft, Airbnb, and Uber began during moments of economic instability, identifying emerging needs and offering innovative solutions. For entrepreneurs, the first crucial strategy during a crisis is to focus on addressing urgent and specific problems. This may involve adapting existing products or services to meet emerging needs or creating entirely new solutions. For example, during a recession, services that provide savings or increase efficiency may become particularly attractive. Secondly, maintaining flexibility and quick adaptation is vital. Companies that can pivot, that is, changing direction rapidly, can seize unexpected opportunities. The ability to adjust your business model to align with the changing economic reality can be the difference between success and failure. Additionally, applying rigorous financial management practices is fundamental. This includes closely monitoring cash flow, avoiding excessive debt, and prioritizing investments that offer quick returns. Small entrepreneurs may consider creative financing alternatives, such as partnerships, crowdfunding, or microfinancing. Finally, investing in digital marketing and effective communication can amplify the company's visibility and reach. In times of uncertainty, transparency and clear communication with customers are essential for building trust and loyalty. Personal finance management and debt reduction. During periods of economic recession, maintaining strict control over your personal finances and working on debt reduction are crucial steps to ensure financial security. and even take advantage of investment opportunities. This chapter addresses practical and effective strategies for managing your finances and reducing debt while navigating uncertain times. Managing your personal finances during a recession starts with creating a detailed budget. It is essential to understand where every penny of your money is going. Use tools like spreadsheets or financial apps to track your monthly expenses and identify areas where you can cut costs. Focus on basic needs and eliminate or postpone unnecessary expenses. A well-structured budget not only helps control expenses, but also allocates resources for emergencies and investments. Creating an emergency fund is vital during a recession. We recommend saving between 3 to 6 months of subsistence expenses. This fund serves as a financial cushion against unexpected events, such as job loss or medical expenses, ensuring that you do not need to resort to expensive credit. Debt reduction should be a priority. Start by focusing on debts with higher interest rates, such as credit cards. Use the snowball or avalanche approach to pay off your debts efficiently. The former focuses on paying off the smallest debts first, giving a sense of progress and motivation, while the latter prioritizes debts with higher interest rates to save on interest payments in the long run. Negotiating better terms with creditors can also alleviate financial pressure. Many are willing to offer extended terms or lower interest rates, especially during recessions. Take advantage of aid programs and government incentives that may help renegotiate debts or provide temporary financial support. Automate payments to avoid delays and fines, and consider using consolidated debts to simplify your payments and possibly obtain a lower interest rate. Keep a detailed record of your progress in debt reduction to stay motivated. Effectively managing personal finances and reducing debt not only allows you to navigate a recession more securely, but also puts you in a robust financial position to invest and eventually thrive as the economy recovers. Investing in emerging technologies and startups during a recession requires a careful and innovative approach. Firstly, it is essential to understand the technology and innovation environment. Sectors such as artificial intelligence, AI, biotechnology, fintech, and renewable energy are at the forefront of disruptive changes and tend to attract investments even in difficult times. To identify promising startups, start by evaluating the founding team. Teams with solid experience and a proven track record of success are more likely to develop scalable and adaptable solutions. Additionally, examine the startup's target market. Startups that solve real and critical problems or provide efficiency in sectors resilient to crisis have a higher chance of thriving. Due diligence is another crucial aspect. Analyze the business model, finances, and growth forecasts in detail. Use metrics like the compound annual growth rate, CAGR, and gross margin to assess the company's financial health. Successful investors, like Warren Buffett, emphasize the importance of investing in companies that demonstrate not only innovation, but also economic viability. Adopting a long-term perspective is fundamental. During the recession, many emerging technologies and startups may face temporary difficulties. However, those with solid business models and true value tend to recover and thrive as the economy improves. Finally, diversify your investments. Do not concentrate all your capital in a single startup or emerging technology. Investing in a diversified portfolio of startups spreads risks and increases your chances of success. Investing in emerging technologies and startups during the 2024 recession can be a strategic and lucrative step, providing it is done with careful analysis, long-term vision, and an innovation mindset. Overcoming fear and making rational decisions. Understanding and controlling our emotions is crucial when the market is falling. The ability to remain calm and make decisions based on rational analysis rather than emotional impulses, can determine the success or failure of an investor during a recession. Let's explore techniques and strategies that not only help overcome fear, but also promote solid investment decisions. Fear during recessions is legitimate, as economic uncertainty can jeopardize invested capital. However, fear can lead to hasty decisions, such as quickly selling valuable assets or refusing to take advantage of buying opportunities. Recognizing fear as a natural part of the investment process is the first step to its effective management. A widely recommended technique is meditation and the practice of mindfulness. These practices help calm the mind, promoting a more rational response to stressful situations. Another approach is to maintain an investment journal, where the investor can record their emotions and thoughts before making major decisions, helping to avoid rash actions. Instead of being swayed by alarmist headlines, a successful investor should rely on concrete data analysis. Examining financial reports, market trends, and expert recommendations allows for a clearer and more informed perspective. Technical and fundamental analysis tools are essential for objectively assessing opportunities and risks. Warren Buffett emphasizes the importance of patience and discipline, especially during periods of crisis. Adopting a long-term view and resisting the temptation of frequent portfolio adjustments is fundamental. Setting up alerts and regular reminders to review investments can help maintain focus on long-term goals. Applying Buffett's margin of safety philosophy provides an additional layer of protection. Investing in undervalued assets, which have a higher intrinsic value than their current price, provides a kind of buffer against market fluctuations, increasing confidence to hold positions during the recession. Participating in investor communities, forums, and discussion groups can offer emotional support and valuable insights. Sharing experiences and learning from the mistakes and successes of others can inspire confidence and reduce the sense of isolation. Applying Buffett's strategies in the context of 2024. To apply Warren Buffett's strategies in 2024, it is crucial to first understand the fundamentals behind his approaches. Buffett is known for following a value investing philosophy, focusing on acquiring stocks of undervalued yet financially sound companies. During a recession, many of these companies may indeed be undervalued, presenting ideal investment opportunities. A central strategy is identifying companies with durable competitive advantages, or moats, which provide protection against competition and ensure long-term sustainability. In 2024, sectors such as technology, healthcare, and renewable energy could be explored to identify these moat-holding companies. Additionally, in the recessive context of 2024, the importance of the margin of safety becomes even more evident. This involves purchasing assets at a significantly lower price than their intrinsic value, minimizing risks in a volatile economic environment. Using fundamental analysis tools will help accurately calculate this margin and ensure that investments are made prudently. Diversification is another cornerstone of Buffett's strategy, crucial for protecting oneself in times of uncertainty. In the 2024 scenario, diversifying not only into stocks, but also across different sectors and even asset classes, such as real estate and emerging technologies, will offer a shield against market volatility. The long-term mindset, another Buffett principle, is particularly relevant. Investing with a view to the future and not being shaken by short-term fluctuations is crucial. Recognize that although the market may experience immediate turbulence, solid companies will continue to grow and generate value for their shareholders. Finally, utilizing hindsight analysis through historical case studies can offer valuable insights. By observing how Buffett acted during previous recessions, we can replicate these tactics in the current context. For example, Studying the 2008 crisis and the strategies he implemented can provide a roadmap for 2024. Applying Warren Buffett's strategies in the specific context of the 2024 recession requires a deep understanding of his principles and a careful adaptation of techniques to the nuances of the current scenario. By doing so, investors can not only survive the economic crisis, but also thrive, ensuring a solid and promising financial future aligned with the lessons of the greatest investor of all time.